Welcome to week 2, where we're talking about transactions affecting the accounting equation and then how to post those transactions. So here we're going to look at an example problem similar to what was on the homework. So let me just jump over there real quick. So here we're going to be talking about the accounting cycle, journalizing, posting, and preparing a trial balance. So here we have several entries. First, we're going to determine how they impact the income statement and the balance sheet. Then we're going to post those transactions via the journal entry, input them into the T accounts, put together our trial balance, and then finally summarize them for the balance sheet. So let's start with the impact on the income statement and balance sheet. So our first entry is the corporation issued 60,000 shares of capital stock to Wendy Winger in exchange for $60,000 in cash. The first step in analyzing a transaction is to figure out what's happening and the accounts that are involved. So here we have 60,000 shares of capital stock in exchange for $60,000 cash. So our two accounts are cash and capital stock. Our cash is going up and our capital stock is going up. Cash is an asset, capital stock is equity. So our accounting equation remains in balance. So our assets are impacted because cash is going up, so it's increasing, and our owner's equity is increasing, and everything else stays the same. So there's no impact. Or no effect, I should say, any. All right. The next entry, they did June 1st for us. So the next entry is June 2nd. Purchased a plane from Utility Aircraft for $220,000. Made a $40,000 cash down payment and issued a note payable for the remaining balance. So here, there's actually 3 accounts that are being impacted. The first is that we bought a plane. So that is going to be an asset. Our assets are going to go up. That is a piece of equipment that we now own. We paid $40,000 in cash, so cash is going to go down, which is also an asset. And then we issued a note payable. A note payable is a liability, and that is increasing by the difference. So 220 minus 40,000 is 180. So let's look at the impact here. Our assets are going to go up by 220 for equipment. However, they're also going to go down by 40,000 for the cash. So the net impact on assets is an increase of 180,000. So that's going to be an increase. Our liabilities are also going to go up 180,000. And everything else is going to have a net impact of 0 or no effect. June 4th, paid Woodrow Airport $2,500 to rent office and hangar space for the first month. So the 2 accounts that are impacted are cash went down $2,500, and this was for rent. So our rent expense actually went up. There's going to be an increase there. So let's look at here. Our cash went down for $2,500, so it's a decrease. And our expenses went up. Therefore, there was no net effect on revenue. Expenses went up. Therefore, our net income goes down because revenue stays the same, expenses go up. Therefore, our net income goes down. And net income rolls up into equity, which also went down. And there's no effect on liabilities. So you'll see that the balance sheet has to remain in balance. Assets went down, owner's equity went down. I'll do one more. Billed customers $8,320 for aerial photographs taken during the first half of June. All right, so they're billing their customer. What does that mean? That means that they provided a service which was taking aerial photographs. That means that's going to be revenue, okay? So our revenue is going to go up $8,320, and they billed their customers. They didn't collect the cash yet, so that's accounts receivable, which is also an asset. So our assets are going to increase. Our revenue is going to increase. Expenses have no effect. Therefore, our net income in total increases. Net income rolls up to equity on the balance sheet. So there's an increase there, and then no effect on liabilities. That's an example of how we would fill out this problem. If you would like to see the rest of the answers, you can go to the practice problems, and it's problem number 5 of the practice problems and problem 3-4A in the book. So let's move on to part B. Here we're actually going to do the entries. So the first one is to record the issue of stock to Wendy Winger. So you'll remember that $60,000 of capital stock in exchange for $60,000 cash. So cash is going to go up. That's going to be a debit to cash of $60,000. And then our capital stock is also going to go up, and that's a credit because equities increasing is a credit. Okay, so let's record that entry. Next, we're going to record the purchase of the plane from Utility Aircraft. So, sorry. And they actually gave you the titles of the accounts that they use. So we purchased aircraft for $220,000. So remember, that's an asset going up. So the asset is the aircraft. It went up $220,000. And then we talked about that our cash is going to go down because we paid $40,000 for cash. And we increased our note payable, which is a liability, for $180,000. So you'll see our debits are $220 and our total credits are also $220. The next entry is to record the payment of office rent for June. So our rent expense went up and our cash went down. Those are the two entries that are impacted. And it was for $2,500. So we have a debit to expenses, a debit to equity decreases our equity, and rent expense decreases our equity. And cash went down, so a credit to an asset decreases it. The next entry is billing our customers for $8,320. Okay, so our revenue goes up. Revenue increases equity, and an increase to equity is going to be a credit. So here we have aerial photography credit went up $8,320. And we didn't get cash, so they still owe us. So we're expecting to receive that cash in the future. It's going to be accounts receivable, which is an asset. We're going to increase our assets. All right, entry 5. We paid $5,880 in salaries earned by employees during the first half of June. So we paid it. That means cash went down. And it's salaries expense. So we know that cash went down. It's going to be a credit. I think it was $5,880. Yes. And increase in expenses is a debit because it decreases our equity. Okay. Next entry, record the payment for repair services. So they paid Hannigan Hanger $1,890 for maintenance and repair services. All right, so we paid cash for that. It's going to be similar to the entry that we just did. Cash goes down, 1,890, and our repair services goes up. Okay, let's see if we can find that in the list. Maintenance expense. All right, and you'll see that while I'm doing this, I'm putting the debits first. Debits always come first. Record the entry for the portion of customer bills collected. All right, so we collected $4,910 of amounts billed to customers on June 15th. All right, so on June 15th, we billed customers, remember the $8,320? Well, we're collecting a portion of that. So that means that we had an account receivable balance, and it's going to go down. Accounts receivable is an asset. It's going down because we're collecting the cash now for $4,910. And we're collecting cash. Cash is going up. Cash is an asset. 4910. All right. A few more entries. Billed customer $16,450 for aerial photographs taken during the second half of the month. Again, this is revenue. We provide the service of taking photographs. So revenue goes up, equity goes up, that's a credit. And it was $16,450. We billed them, we didn't collect the cash yet, so it's going to be accounts receivable. It's an asset. Assets going up is a debit. Paid $6,000 in salaries. All right, so we paid cash. Cash is going down. That's a credit. Whenever an entry involves cash, I like to do that first because I think that's the easiest to understand. And once you figure out that side of the entry, the other side of the entry is obviously going to be the other way. So we paid for salaries. That's an expense. Expenses decrease equity, therefore debit. All right. Received a $2,510 bill from Petrie Petroleum for aircraft fuel purchased in June. The entire amount is due July 10th. Okay, so we received the bill. It's going to be an expense because we bought this, right? We're purchasing something. A purchase is an expense. If we don't pay it immediately, it's going to be a payable. Okay, so the way that I like to think about it is receivables are for revenue, R&R. Purchases are payables, P and P. So that's how you can remember if it's a receivable or a payable. Are you purchasing something? It's a payable. If it's for revenue, it's a receivable. Okay? So this is going to be an expense for fuel. So let's see if we have fuel expense. I think it was $2,500, right? No, 2510. Sorry. Again, expenses decrease equity, so it's a debit. And then we're expecting to pay it in the future for a purchase, so it's going to be a credit. Our accounts payable go up, that's a liability. Credits increase liabilities. And then finally, we're declaring a $2,000 dividend payable on July 15th. So we haven't paid it yet, so it's going to be a payable. If you increase a payable, that's a liability. That's going to be a credit. Okay. Is it 2,500? 2,000, sorry. And then dividends declared. It's going to be dividends, 2,500. Record the entry. Okay, so now we have all of our entries listed here, okay? I'm going to pause the video and do a second half, and we'll complete the rest of the problem.